Good morning, everybody. Thank you so much for joining us in what we hope to be a riveting conversation today on ESG and investment in the Canadian energy sector. My name is Ravi Latour. I'm a partner in the Securities and Capital Markets group here at BLG. And we've been seeing significant interest in environmental, social, and governance issues. Many of our clients, in particular in the energy industry, are talking about investment and how these kind of factors are playing into how investors are seeking investment into the energy sector. So we thought it would be a great idea to bring two great professionals in the space out to talk about their thoughts, in particular with investment and ESG. Before we get started, I'd like to just briefly introduce our two panelists. Kevin Krauscher is here. He is currently the CEO and co-founder of Avatar Innovations, Inc., which is a groundbreaking project empowering real energy transformation through, among other things, educational programs, a collaborative accelerator program for new energy projects, and a venture capital fund that will be targeting investments in clean technologies from hydrogen, carbon markets, renewable natural gas, nature-based climate solutions. Prior to co-founding Avatar, Kevin was the CEO of Canada's oldest drilling company, where he championed some of the first fully computerized drilling rigs in the world, and leading the first long-reach horizontal well in the Canadian energy sector, in the Arctic, sorry. Kevin also serves on the steering committees of both the Clean Resource Innovation Network and the Energy Futures Lab. If you have ever been involved in the energy investment space in Alberta, there's a good chance you've met our other panelist, Arun Chandrasekaran. Arun has significant experience in energy investment banking and was ranked a top 3 Brendan Wood Top Gun energy investment banker. Since 2016, he has been the head of National Bank Financial's Energy Investment Banking Division, and prior to that, spent time with the firm as a managing director in corporate investment. Arun has also worked as a principal with Stream Asset Financial Management and as vice president at Tristone Capital Inc., which is an energy-focused boutique investment bank. So we'd like to maybe spend the next 30 minutes or so having a fireside chat-style conversation with Arun and Kevin, talking about some of the issues that we see people facing in the energy sector when it comes to trying to retain investment. That'll be the focus of the discussion today. We do have several other series that will be coming as part of this ESG movement by BLG, including topics on ESG reporting, ESG corporate governance. So while we will touch on some of those issues today, the main focus is really to understand what Kevin and Arun are seeing in the investment space when it comes to ESG. At the end of that, we'll open this up for questions. We've got several great questions from many of you attendees, which we'll try to discuss as many as we can, time permitting, and we hope to wrap this up by 9:45 Standard Time. So to get started, as all of you are aware, ESG has become quite an important topic in recent years and is increasingly impacting how investors are making investment decisions. Many Canadian companies in the energy sector do note, however, that they've been hitting ESG benchmarks, particularly from an environmental perspective, for many years prior to the current focus on ESG, in part because of strict regulations in Alberta and Canada. So, Kevin, Arun, we wanted to hear your thoughts on why you think there's been an increase in the focus on ESG standards with respect to energy companies, and how can you see this trend continuing? Maybe we can start with Kevin on that.
Sure, yeah, like certainly, well, first of all, thanks for having me, Ravi. And certainly Canadian energy companies have been global leaders for decades in many ESG metrics, and far before any of us had ever even heard the term ESG. However, you know, the recent focus on ESG is really due to a changing sentiment in the investment community. I'd say the trend on ESG, you know, really started kind of around the 2017 era, and that was when some of the major institutional investors started using it. You had the emergence of these ESG rating agencies, and their logic was that companies which scored high on ESG metrics performed better in the long run, both from a return perspective and a volatility perspective. So this really, I think, informed the analysis around sort of non-financial risk factors. But this trend really accelerated from sort of 2017 to 2017 with ESG reports and benchmarking, sort of moving from this kind of nice to have, you might have a report, to really a must-have for public companies. Frankly, the pandemic, I'd say, was just throwing this into overdrive, and I think the trend is going to be continuing. There's been a full-scale shift in the investment sentiment from both institutional and retail investors, seeing the future of investing in a new lens.
Varun, do you have any thoughts on what you're seeing in respect to that?
Yeah, absolutely. I think, first and foremost on the energy sector, easy to pick on fossil fuels, very, very simplistic in nature. Obviously, it's easy press to put the X on that side of the equation, and clearly with government initiatives here, including Biden's $1.2 billion clean tech and clean energy plan, going away from, call it, conventional means, and followed on by what the Liberal government in Canada is saying. Again, it's just an easy sector to be at the forefront of this. Kevin's absolutely right. I mean, it's just going to be very much a disclosure issue going forward. We can't stop what hydrocarbons are, but in terms of environment, social, and government, and starting with environment being the most important of the three for sure. Canadian producers have always done an excellent job of being environmentally conscious, setting the standard worldwide, and now it's all about disclosing what we are doing to appropriately reduce those emissions, putting technology to work, etc. And I think that becomes key. Is it something we can ignore? Absolutely not. $36 trillion now worldwide AUM is focused on ESG investor sentiment, and all three disciplines, very, very important. The S and the G, from my perspective, are, again, just natural things and natural, ways of the world in terms of where we are moving, but all just extremely, extremely important from a focus perspective. The S and having diversity and inclusion, and G, just good governance is always been something that's important, but now that magnifying glass is definitely on the space, but there are resulting investment dollars behind it too.
Right. You kind of touched on something that I'd like to talk about, and this ESG is just very broad in scope. You kind of mentioned in your view, environmental is definitely the most important factor for the oil and gas and the energy sector. But ESG can range from environmental issues to diversity and inclusion, indigenous relations, anti-bribery, anti-fraud efforts, corporate governance. Kevin, maybe why don't you talk to us what you think in terms of these kind of trends? Environmental is definitely important, but what other factors are you seeing people increasingly kind of target or be concerned about in the ESG scope, if you will?
Yeah, this is an issue that drives everyone in the oil and gas industry crazy because we're so good on the S and the G. In terms of the specifics of how these rating agencies are calculating their algorithms, I'm certainly not an expert on it, but what I would sort of suggest is I think that the companies, especially the large caps who are really, really focused on this, probably have a pretty good understanding around how these algorithms are being calculated. And even though energy companies have gotten really much better on their environmental performance in the ESG rankings, the challenge for the oil and gas sector is really around scope 3 emissions. So understanding this, if you're not familiar, like scope 1 emissions are from your direct operations, scope 2 operations are from the power you consume to be able to generate it, and scope 3 is everything else in your supply chain. So despite having the absolute best scores on the S and the G, if you're producing a product where 80% of the emissions come out of the tailpipe of your customer, you have to get really creative about how you manage the E part of your ESG ranking. And so, we bang ourselves against our head, or against the wall on this issue. But I think the good news is there is the emergence of a lot of really interesting solutions to be looking at the E part or the scope 3 emissions part of the calculation. But that's really where we're getting hammered.
Right. That's a really interesting comment. And if you look at some of the rating agencies like Sustainalytics, if you will, all oil and gas companies, for whatever reason, are high risk, generally speaking, in their ESG ratings, and that's likely due to the environmental aspect just as part of oil and gas. Now, in your view, is oil and gas and energy really a higher risk investment? And, what can producers do to combat this perception?
I can talk. Do you want me to tackle that one, or Arun, do you want? From my perspective, I think there's this, despite this like conversation around climate risk, as you will, climate risk, if you have an offshore platform and the increasing prevalence of hurricanes is going to have a material effect on your risk going forward. I wouldn't say that's a huge issue for the vast majority of Canadian producers. But where I would say, so I want to kind of separate, I think, that conversation around climate risk and then around ESG metrics of how investment decisions are being made. So I don't think climate risk is going to be a huge driver of impact of the perception of it. It's still that Scope 3 emissions challenge that, how does the energy companies of the future really look at their full life cycle emissions? And that will be, I think, where the capital is going. And you're seeing it from the large caps who still have the institutional investors and not just the retail investors to be able to get there. That's, I think, the way I'd be thinking about climate risk versus this, but I'd be interested in Arun's thoughts.
Yeah, I think first and foremost, my number one comment is total return. So before we even get to the ESG side, are you showing returns? And are you able to have an investable business? So don't show me the first 5 pages of your corporate presentation about ESG and then tell me how you've lost money for the last 6 years. That's number one. Post that, listen, I think we need to appreciate and understand that, and I think to your comment, Ravi, and Kevin's comments on emissions, listen, you burn fossil fuels. That's the reality. It's always going to score on the higher risk side of the spectrum. That being said, I think the path to reduction is very, very important. The path to disclosure on those reduction is very important. If you look at even the MSCI Leaders Index on ESG, there is big emitters of greenhouse gas within that ESG index that support the E&P space. But what do they do good at? They do, they're larger cap, but they do very good at disclosure. They do very good at their sustainability reports, very clear on the S and the G, but also on the E in terms of everything they are doing to clean up and on a relative basis produce the barrels as sound and as environmentally conscious as possible. And so I think it all does play together, but you don't want to get away from the reality of the business needing to show returns. And as you talk to the investor climate as well, a big factor for them is, listen, we don't want to see entities now go overcommit capital to, to moving the ESG index to lose money on these projects. And so just going out and adding solar panels to, everything you have in the field and adding a bunch of cost. Well, what is the real energy efficiency of that? How much are you really, helping from an environmental conscious perspective? So I think what even the investor climate is smart to is not just a bunch of smoke and mirrors. They would like to see, again, companies are doing the right things, have the right disclosure, but make returns. And I think that, the energy industry has been tough in that, we've had a lot of volatility, not only from the commodity side of the equation, but the political side of the spectrum. And clearly we are beholden now to very much world pricing, especially as it relates to oil. These are going to continue to be factors that, again, we need to manage our businesses around, small to large. But again, we definitely need to be checking the box on the various disciplines of E, S, and G while you're doing that.
Hey, Arun, you just raised an interesting point. You talked a little bit about how the larger companies are able to provide disclosure, which the investment community seems to find satisfactory, and obviously focusing on returns. How about for some of our smaller or mid-market companies in the energy space? Do you think that there is satisfactory disclosure out there for investors, or are there any things that you can see that they need to improve on? What are they really? What can be done differently to kind of achieve what these larger companies are achieving on these indexes?
Ravi, if you're asking if they should hire BLG to do their sustainability reports, then the answer is absolutely yes. I mean, you might as well hire Kevin and myself on the advisory side too. But outside of your shameless plug, Ravi, I would say I still think there's a size threshold, to be very, very honest. Listen, I do think that sustainability reports are going to become more and more of the norm. I think that they should be published appropriately now. Especially any public company should definitely have something out there. And I do think that the regulatory framework is going to go in a direction which will put real confines to the information that is in these reports. Because one thing we are seeing right now is that none of it's apples to apples. So people are forcing the disclosure out there because they feel like they need to. And again, for a smaller cap company, I don't think that you should be putting undue time and attention to it. I appreciate that you want to check a box, but the reality is, investors aren't reading those reports for you. You need to be of a certain size threshold where they actually care, have their internal ESG groups are putting material capital to work. But, in the smaller realm, when guys are investing, $4, $5, $10 million, they're not reading these reports. And so appreciating that you want to now have it as ongoing disclosure, and it's important, no different than you would do an annual report. You should have a report to address these things and be prepared for what I do believe is going to be a specific way of data collecting and analytics that is, uniform across companies, that I think will be and become very, very, very normal course.
Great. Yeah, Kevin, I mean, you are obviously involved in looking at venture companies. You're working with companies, as I understand it too, that would be kind of in the clean tech space and helping kind of maybe potentially companies satisfy some of these requirements. Now, what type of just generally on the venture side or smaller company kind of reporting, are you seeing private companies doing anything like that, or do you think they should be doing maybe not the full suite of reporting, but what kind of steps can they take maybe?
Yeah, like if we're I think Arun was spot on how large caps and small caps should be looking at this very much differently, and I'd say private companies need to be looking at it differently as well. It depends what your investor base is, right? And so the work that we're very much doing right now is looking at where those investment opportunities are to be able to tackle the Scope 3 emissions challenges, in the sense that this is really a pressing issue for a lot of large cap companies, and those solutions exist in areas like renewable fuels. You're seeing some pretty major investments be going into that. You're seeing investments going into hydrogen. You're seeing investments going into carbon capture. These are the solutions that are going to be able to look at it. So from a private company perspective, there's a large amount of opportunity that exists in that space. So I don't know if they should be looking at it from a disclosure perspective or reporting perspective. I'd be looking at it from a business opportunity perspective of, if this is like right now, the trading or the EBITDA multiples for clean tech companies are like 40 times. And, this is where the money is going. How do you look at that from an opportunity perspective to be able to tackle and benefit the, large cap companies that are looking at this pretty seriously?
Great. One thing I wanted to talk about maybe is just what you guys are seeing in terms of securities pricing when it comes to ESG factors. So Larry Fink, as many of you will know, the CEO of BlackRock, he writes a CEO letter every year. In his letter last year, he talked about how climate risk is investment risk, and that markets are going to start pricing climate risk into the value of their securities, sparking a fundamental reallocation of capital. Arun, you talked a little bit about how there are funds and investment dollars that are going into the ESG space specifically, or looking at that. Have you seen Canadian energy companies starting to price climate risk or other ESG factors into their securities pricing?
No, I fundamentally don't believe it. I think right now you've got an interesting spectrum. So there is definitely a small bucket that, from an investor climate perspective, just won't touch hydrocarbons anymore, fossil fuels. They've just exited that from their portfolio. They're not talking to any of us. There is also on the other end, swing the pendulum. On the other side, there is a bucket that doesn't care. Will continue to worldwide invest holistically, don't have any ESG threshold regard. The biggest part of the investor sector is in a gray area right now, where it's absolutely a care factor. ESG thresholds are are needing to be met, but at varying ranges of the spectrum. More and more what we are seeing is within these institutions, companies are getting quote unquote ESG scores. And that does become important when they are making their investment decisions, i.e. one investment advisor put to me or institutional investor put to me, listen, if I'm wrong and the stock price goes down dramatically and my return gets hit and it had a really bad ESG score, I'm going to have to talk to my boss about that, right? So like they are being more and more cognizant of it. At the same time, they do appreciate over time, the headwinds are such that it will become a more and more important dynamic. Again, nobody absolutely understands the full framework of it. And to put this in context, even if you look at I mentioned it previously, there's a lot of ESG indexes, but the MSCI leaders, there's over 30 different criteria that goes into it. There's no company that could check the box on all of those criteria. And in fact, when you look at the criteria, they're very vague in nature. And so to put that into context, are people really investing on that basis right now? No, I don't believe that. I believe their total return first, then they're absolutely looking to check a box. And if they can't check that box, that is going to start to hurt you over time. How do we quantify that, Ravi? I think that's still quite difficult until you have a much cleaner regulatory framework and more apples to apples data. But at the current moment, I would say it's a check the box exercise alongside, is the business producing real return?
Right. You kind of mentioned something interesting about how certain investors have just exited the space entirely. I don't know, Kevin or Arun, what are your thoughts? Is there something that can be done to bring those investors back, or are they just gone for good? Is there education or anything that can be done, from the industry itself?
Well, I think it depends on the investor. I think there's going to be a small subset that will never get back, but the reality is capital is going to flow wherever there's returns. And so that's also the tricky part is, the industry is going to have to demonstrate probably 2 years of solid returns before I'd say serious capital is going to be coming back into it. And then the other challenge out of it is just these deal sizes are too small. Like there's a number of investors that are just like, look, I can get my entire coverage on energy from investing in one company. How do you get the deal sizes larger? I think yesterday you started seeing some of the emergence of the much needed consolidation in this industry to be able to get there. But it's not a ESG issue. It's return issue and a regulatory issue and a deal size issue, I'd say. But I'd be really interested in Arun's thoughts on that too.
Yeah, I absolutely agree with Kevin. I mean, I think there's a small subset that will not be back. I mean, I think they've put the mandate out there. Their LPs don't want them there. And frankly, some of it is very close to home. There's no question about it. And so, do I think there is a subset or a subset that their big pool of funds will never touch it again? Yep, I do absolutely believe that. And for them now, it becomes the headline side of the equation, and again, it's they're just following the trends and leadership of government. So, how big will that subset be? Again, it really does come back to the return potential. I think, again, in that big gray area I talked about, those investors will continue to find ways to invest in good return projects. There's also no question about that. So can we limit now the amount of investment that just completely leaves energy? I think that's up to the industry. Listen, it's also up to worldwide phenomena. It's also up to our political spectrum, but you do need to watch where the winds have changed on that side of things. You do need to see what Biden has come out with and what Trudeau has followed with. And again, I don't think it's about now, Ravi, bucking against it. I think it's about adapting to what's happened in the political regime, and also appreciating that the other side of this is there is going to be a big demand for fossil fuels. You can't just jump into clean tech and all of a sudden think that your house is going to be powered by hydrogen next year. And the other side of fossil fuels, I think, as we can all agree, is as we all sit here at home or selectively in the office through COVID, what do you guys think is going to happen after COVID? We're all just going to sit on Zoom and never go anywhere with our families? Or do you think we're going to jump on 48 plane rides next year? And what do you think the world's going to do, right? So I think you are going to start to see Demand spikes on the hydrocarbon side. Demand spikes lead to commodity price. Commodity price leads to returns. Investors all of a sudden sit there and say, okay, how do I make money in this? And so that spectrum I still believe is going to play out here. I don't think any of us are arguing as well. We need a clean tech side. We need that investment. It is absolutely starting to happen right now, but it takes time. All of this stuff takes time. Those technologies will grow over the next 3, 4, 5, 10, 40, 50 years. And in the meantime, we are still going to use a lot of hydrocarbon production. Last time I looked, the world still uses coal. So, we need to be thoughtful to that, but we need to be smart to it too. And this is why, for the same reason you're putting this webinar on, it's something that we do need to appreciate and adapt to the world in terms of the E, the S, and the G.
Perfect. You talked about something that I think I want to delve into a little bit more here, and that's the politics here. So we've talked about how companies can, position themselves and how important it is to them to retain investment. Any thoughts on what government can do to kind of help with that and help us in our, efforts to really, let the market know that the oil and gas sector and the power sector and the energy sector in Alberta are, generally following good ESG rules and are trying to make, a difference here?
Yeah, I have to choose my words a little carefully here, but I'd say one of the big things is that Arun is exactly right. The hydrocarbons industry is going to be with us for a very, very long time and deliver a very high quality product that advances our quality of life and our standard of living. But at the same time, the world has decided it wants to decarbonize. That is going to be a multi-decade approach, and this debate and this challenge of how we've politicized energy, that you're either for hydrocarbons or you're against climate change, is a really, really unhelpful political dialogue to be making these types of long-term strategic investments. So from a political perspective, we have to figure out how we make the investment case around both the importance of the energy sector as well as the energy transition to a lower carbon future palatable to both the left and the right, because this is going to be a multi-decade issue, and every time we change a government, we can't rip up the plan. And so there has to be, I think, a cooling down and a ratcheting down and a depoliticization of energy. I don't know if it's possible, but I'd say that would be the area that the advisement I would be providing governments, is that this is far too important of an issue for our country and for our future for us to turn this into a political handball that every time we change a government, we rip up the strategy.
Yeah, it's very elegantly put, Kevin. No swears used, so that's appreciated. No, yeah, Kevin's right, and to be very honest, I think all we need from a government perspective at this point is to merely suggest we need it all, right? We need all forms of energy. We want to definitely decarbonize. We definitely want to get into the clean tech space, but it takes time, it takes investment, and at the same time, why are we crippling ourselves? Why are we chopping off a leg to keep an arm? It just doesn't make sense fundamentally. It doesn't make sense from a GDP perspective. It doesn't make sense from a worldwide competition perspective, right? I mean, Biden, look at Biden's slogan, sorry, it's America first. Why have we never said Canada first? Why don't we look out for ourselves for a second and reap the rewards of, not only the land we've been given, but the resources we've been given, and use that to our own benefit, and then allow some of the smartest, most professional, most entrepreneurial companies, thought leaders in the world reinvest that money into, clean tech, carbon capture, everything. And you're seeing it already. You're seeing what our entities can do, what smart professionals can do. They are the best, well set up. Whitecap runs one of the largest carbon capture units in the world. That sits here in Canada, in Saskatchewan. We have the thought leaders and the ability to do all of these things, but you can't have the government slinging mud the whole time while we're doing it, and disallowing investment dollars to flow appropriately. And so that becomes, I think, the easy commentary, which is just ease off. Everybody appreciate that we need the commodity, we need fossil fuels. It does heat your house. It would be nice for out east to see it the same way as out west. And again, let's just move through this together. So does the government need to do much more than that, Ravi, at this point? No, because we don't expect much more than that. But it would nice to see just a bit more alignment towards cohesively doing this. And again, Kevin put it very smartly. It's not a yes hydrocarbons or no hydrocarbons. It's listen, it's a way of life. It's a way of our standard of living.
Right. Perfect. Great. Another thing you kind of mentioned earlier there, Arun, was COVID-19 and, building back, and are people going to be using energy more, and how that's kind of going to affect the sector. COVID-19 has obviously significantly impacted business in Canada. Many stakeholders now are demanding that the world build back better. Government is looking to do that and create a more inclusive, sustainable kind of environment for everybody. When we emerge from COVID-19 and energy companies are looking to retain more investment dollars, besides the environmental piece, like what can Canadian companies do you think, to emerge successfully from COVID-19? And do you see there's going to be a trend where there's going to be more energy investment post-COVID-19?
Joe, you go ahead, Arun. I'll tackle that one after.
Sure. Do I think there's more? I think there's more because I think we're in a very interesting commodity run, and investors are looking there's a good pulse in the space. Stock prices are rising to this exact trend of post-COVID. We're going to see an oil rally. We're going to see, demand spike, and supply is going to be required. And so I think everybody is very well prepared for that, and investors are going to follow suit. In terms of more investment, that's such a difficult thing to talk to, outside of saying I think investors are going to continue in the energy space, want to deviate in the public markets towards size and resiliency now. I think that they would like to see less smaller cap entities in the public market. And again, when their investment dollars are at work, they want to see liquidity too. So investors also appreciate that, and on any given day, month, or year, they're at the crosshairs of not only the political spectrum, but they're obviously employers and their LPs behind their capital. And if those ESG trends change all of a sudden, and it's like, well, we need to start liquidating, to be stuck in something smaller becomes very, very difficult for them. And so I do think that size and resilience will be one of the things that continues to play the day. I do think it does come back to the return side. So it's not really a COVID versus non-COVID thing. I do think that the pools of capital as it relates to energy hydrocarbons in Canada is smaller than it's ever been historically. While that might grow here over the upcoming years, I think it's very, very moderate. I think we just need to appreciate and expect as well that the sector is the sector from a Canadian perspective and the size of market perspective that we now offer the world and North America. Is there enough dollars out there, though, to run your company appropriately and do the right thing? Absolutely. But I would be listening for sure to the size construct within all of that. And then again, just tying it all back to the E, the S, and the G, I think that, again, all of these things are important disciplines within those entities. And I think they all will carry into the framework of investable capital over time, starting with returns, but all become very, very important. And again, as that attention becomes stronger and stronger, as those boxes become stricter and what to check and the regulatory framework becomes tighter, you do want to be prepared for that. But again, with probably a certain size and substance too.
Perfect.
I think, Arun, I think you put that really well in the sense that, there is a really exciting kind of commodity run that's kind of going to be happening. Does that bring the capital back in the long term? I think the jury is still out on that. And are we just in a world where companies are going to have to be cash flow businesses and not deploying capital on any of these things, because investors, if they're investing in the space, are going to want to return as much as possible. But, I think that there is a massive opportunity in the energy sector. I tell this to a lot of people. I told this to the premier the other night. I think right now is probably the most exciting time in the Canadian energy space that I can remember in my career, and probably reminds me of what the early 1990s was, or the late 1990s, when we were really uncertain about what the basin looked like. And as the world rebuilds from this crippling pandemic, yes, there's going to be this massive rebound in demand, but the investment community in the world is going to pivot to the next crisis, or the next challenge, and that's going to be decarbonization. The reason I'm so excited about where we're at in the Canadian energy industry is, the renewable sector is a very established sector. There's not a lot of opportunity. Canada is a highly renewable electricity grid. We have so much hydro. The wins on decarbonization are not going to be in the traditional renewable sector. The wins are going to be in the industries most difficult to decarbonize. And the solutions that exist to those are solutions that exist inside oil and gas: carbon capture, hydrogen, long duration storage, stuff we already know how to do really well. And the amount of entrepreneurs, really exciting, research and business development plans I'm seeing, both inside the large caps, inside the startups, this is I think, and I feel like the oil and gas industry of the late 90s, where we, really emerged in a new way. And so, if we think about the opportunity in front of us in a new way, I think there's huge opportunity. What Carney said the other day, he thinks it's going to be $3 trillion a year of investment in this energy transition through to 2050. Let's look at that and realize this is a space we can win in. We have the people and the talent and the resources to be able to do it.
Perfect. I think maybe now we can turn to some of the questions that we are getting in from our attendees. Arun, question for you, and I know you've kind of talked about this broadly, but maybe more of a pointed question from Robin Graham, who's a former managing director and wealth management portfolio manager. She would like to know, why are analysts bullish on Enbridge, Suncor, and TC Energy, given the impact of ESG on pipelines and fossil fuels?
Yeah, it's a great question. And I think that Enbridge and TC, as a starting point, have a number of things towards the energy transition side already. They have constructs of their business that are very, very clean energy. They are very renewable driven. They're going to continue to focus on those efforts. Clearly, they still have a hydrocarbon bent as well, but you can also see where there's a natural arb in some of the parts that's going to occur, that they either get that cost of capital within their own entity, or they start to spin off those offshoots and reap the rewards of clean tech. Right now, again, as we talk about clean tech, that market is blowing up. There's over 20 companies coming to market right now in the context of things. We brought one out to market this week in the hydrogen space. Absolutely, crazy demand. And so again, I think that when you talk to these three companies as a starting point, and back to TransCanada and Enbridge, they're going to be leaders on this energy transition thematic. And they have infrastructure in place, which becomes very, very important as it relates to energy transition. And so even when you think about the world of hydrogen, which again is in its infancy and is expensive and does come within a requirement for the infrastructure side of the equation, these are going to be the leaders on that side of the equation. Suncor, ESG is not a new phenomenon for Suncor. Go back in time and look at their disclosure documentation for a very, very long time, right? So again, as we appreciate for more of our smaller cap entities, this becomes a new phenomenon. For the Suncors of the world, they've lived this for a very long time, and they've had to live it as well in a world of oil sands and the negativity relating to it for quite some time. When I look at the MSCI Leaders Index as it relates to ESG, Suncor is the largest participant from a percentage perspective, and then they are E&P company. I think this again goes to how important all three are together. How important the disclosure is, how important it is to show a plan towards reduction. And if you look at their documentation, it's very, very much second to none, and they've done an excellent job of doing that and translating that to the investor community, but clearly also the bodies that look at these indexes, et cetera, and are putting these ESG scorecards.
Yeah, I'll add to that, and those three. I didn't plant this question, but those three companies are obviously our big partners in Avatar, but they're absolute leaders on this file. First of all three of them are very good cash flow businesses in a commodity upswing, but all three of them are looking very innovatively at how they bring these types of conversations into their investment strategies. From a return perspective and from a strategic perspective. You've got, Enbridge, a massive renewable company, even though no one, understands them to be doing some really exciting stuff on hydrogen. You've got Suncor doing some really exciting stuff on biofuels with that new biofuel plant they're building in Montreal. And TC Energy is doing really cool stuff in long duration storage to tackle the intermittency challenge. These types of large caps, I think, are looking at this as a business opportunity, and that's the way I'd be looking at it for those types of companies.
Great, thank you for that. Kevin, a question from you. This is from Guru at the DBRS Group and Morningstar Credit Ratings LLC. Arun talked a little bit about the price on the security side, but let's talk about returns. Are you seeing at all any investors demanding additional returns from energy investments given ESG pressures or anything from that perspective?
Well, investors are always demanding additional returns. So
Yeah.
I don't think there's anything necessarily new there. But I think looking at it kind of from an ESG perspective, again, I would say it depends on the company. If you're a small or medium cap with a one commodity you're sort of producing, you're seeing this demand spike and this optimism around. Those investors are going to say, let's maintain a really good cash flow kind of business until we can get some sort of swing and consolidate into something bigger. If you're one of the large caps, you should be looking, I think, past however long this demand spike lasts, because there's a lot of barrels of oil on the market on $60. And so how long is that demand spike going to really be looking? So you shouldn't just be riding the next run. You should be looking, I think, a little bit further out, which is what we just commented on the work that the large caps are doing.
Perfect. So I think we're kind of getting up here on time. I just wanted to maybe open it up to the both of you if you had, any closing comments or just general thoughts on, ESG and investment and, what your takeaways from the discussion that you'd like maybe some of our attendees to know about or think about.
Go ahead, Kev. So, I was going to see if you had any smart closing words. What I'd say is, this is an issue to be paying attention of. Obviously, I think what your strategic position as a company is, you should be looking at this in a different way. But broadly speaking, for a Canadian energy sector, I think done right, we can think about this in a way that creates a lot of opportunity for this sector.
Yeah, I agree, and I would just add, adapt and evolve. The reality is this is a new world. We shouldn't do things how we did and have done things historically. I think be very thoughtful to all three. And again, I think that we're already leaders on the environmental side. Like I said, I think we're angling into and anchoring into more disclosure around what we are doing and what we continue to do. But don't forget about the S and the G. They are very, very important. And don't eye roll it. Don't shoulder shrug it. Again, like I said, adapt, evolve, think about things differently, get different advice on these issues. Talk to more youth on this side of the equation as well. They are very, very much in touch with, the evolution here. And again, the adaptation will be the key to success as we move through time, not only in reinvestment, but also reaping the returns of the institutions and entities that everybody here has successfully built today.
Great. Well, with that, I think we can end this. Thank you so much, Kevin and Arun. This was excellent. I myself have learned a lot from this, and I'm sure our attendees have as well. So really appreciate it, and thank you to everybody that's attended. BLG is going to continue with a series of other ESG-focused webinars as well. So if I can ask our team here to show the next one that we have coming up, it's on March 9th. So if you are interested, please join us for our next webinar. It'll be on sustainable finance in Canada, March 9th between 12 and 1 Eastern time. So thank you to everybody here, and we appreciate you joining us.
Thanks, Ravi.
Next time. Take care.
Thanks, Kevin.
Thanks, everyone.
Thank you.